Hello everyone, welcome back to another video. In today's video we're going to discuss how we can navigate the fast moving markets. The volatility is huge, and how we can go about it. Even if you are planning to enter a short, let's say, knowing that the market is short, you'll see a lot of whipsaws or rips to the upside also happening, which makes it quite difficult to in fact scalp. The need of the hour then becomes to have, wider stop losses, and maybe reduce your size so that you can navigate markets like this in a better fashion, or or decide to only trade when you are out of a chop zone. So we will just discuss what I mean by a chop zone. Right now, what we have in front of us is again the NQ. We've not changed any settings from the past sessions that we've been having, and this is a range footprint chart. That is a 50 tick chart. The dots are volume dots, which represent only delta and not the volume. So again, I will, just for the ease of everybody, you can go over here and set it to what I've kept is 7. So the minimum volume that I want to be displayed is 7. So I don't want ones and twos. I want the big chunks to be displayed, and this is volume delta and not total volume. So if you select total volume, you can see total volume over here, but I just want to see delta because that is what I want to navigate when I'm scalping over here. And everything else in terms of price action is really superb. When I see Bookmap over here along with the heat map that you can clearly see over here, we'll just discuss that what we're seeing over here. And the next thing that I have is these volume bars. Again, I will share you the settings that I have. These are 15 seconds, and by time you can do it as you want by volume, but I want to see it by time. So every 15 seconds I see these volume bars, and whenever there is a high volume, I see right over here. So you can see this is the place where there was a high volume, and probably this is the area where it was. So let's consider this example for understanding purpose. So if I see there's a lot of volume and a huge chunk of we'll get our drawing tool out and we can explain further. So if you see what has been going on here is primarily selling. Okay, you see all these 3 range bars. So I will just discuss what the range bar also means, and we see a lot of liquidity. If you see over here on the current order book that you have over here, along with the heat map, you see a lot of liquidity here. So probably what the market can do is, let me get this tool out. What the market can do over here is just what it did here. Take out those stops or whatever the liquidity. Look at the number 101 minus 101. Look at this volume, it's really high. What has the price done? It has not gone down. So this is areas like this, like we just marked, and this is what we've been discussing for the last 2-3 sessions, in fact. Sorry for that. That this is so common that the market goes like this, and when we see what happened here was a step up in liquidity when the market moved here. So maybe a lot of guys were thinking that it will act as a support. They entered here. We don't know the reason, or a lot of stops coming in place with the longs in place. Whatever is the reason, we need not dwell into that. What we are seeing over here is, as soon as it came over here and it approached this part, we saw some liquidity being added at this zone, that is around 350, 349, 350 zones, and the market does move up. It comes back and takes out this liquidity and goes back up. So if you remember, I just clear this drawing. I will state this fact again, and it's a very common pattern, and it's a really high probability pattern. Sorry for this. What we'll do is we'll clear the drawings, and then we'll add one more. What I want to tell you is, let's get the rectangle tool again. So if you look at this, this is the zone where we were seeing support, and the heat map was displaying a lot of liquidity being added in. And when you see, look at this fractal, and when you see this break and pop up back again and take support, this is the place you take entry. It's such a good setup. It keeps happening time and time again, and whenever this time spent in this liquidity zone is so less and it comes back into the range, the next first target becomes this. And this generally happens. Why does this happen? I'll just let you know that when the market is deciding to go in the other direction and someone adds liquidity like this, it will generally take all these orders and go back up to the other side of the range. That is, the first target becomes this, and the next liquidity zone, whichever it is, like for example somewhere here, and it touches that area, and it will keep doing this the whole day if the market is supposed to be in a range bound market, okay? I mean range bound environment. So that is what generally happens. Now again, when you look at the range chart, so another thing that you can actually deploy is look for the times the market is staying in the range. So why do I have a footprint chart on ranges? I get to know how many times the market has been in this particular range. For example, this one time it is moved from one place to the other. This is the second time it has done that. This is the third time, and this is the fourth time it tries to go below and fails, and obviously the target becomes the other side of the range. So you get an idea or an estimate of how many times the market does this before you get a pop to any side. Again, it is not sacrosanct, but you can have these things in play whenever you are, I mean, this helps you create a plan when you are deploying any of your strategies, or rather your money, into this field. And now let's see what is happening here. Okay, so again, in this range, I will just draw this range. What is happening here is I'll get this rectangle tool. So this is a range that we see. Okay, and what we are seeing in this particular range is that again, a lot of buying is coming on the upper side. Again, it is not the majority or the major chunk of it, but there is which is trying to break the market on the upside. And see, this is another example where the market tries to pop up and fails, and look what happens. So and you see there's a lot of liquidity added here at the time, and again over here. So whilst we were talking, you saw some more liquidity getting added here now, and it's just gone, and some has come right here. So if you keep seeing these things, small things, so if you have entered a scalp somewhere here, your target is, let's say, 5 points here, and the next end of the range where it comes. Now when do I, like in the last session, what I was saying is, when do I trail my stop losses aggressively? When I see a sort of absorption. I've not seen it as yet because the numbers are not that high. So it is done and reached the other part of the zone like we expected when something like this happened. Okay, and what I want to see is, before I initiate some sort of trade, there are two things I want to see. The first way I like to take a trade is, one is this, like we just discussed, and the move to the other side happened. Now someone will ask, will I go for a continuation trade after it's broken this range? No, I will not, because again, something like this can happen. It can take support, and you see a lot of selling happening over here, but the market is responding, but I am not sure because I'm already late. One thing I want to trade is, if I am going to take a trade in the direction of this particular move, for example, you can see some liquidity step in here as well. So when I'm planning to take a trade in the direction of the trend, that is this minor fractal or this minor trend that is happening, like let's suppose this one, and I want to take a trade in the direction, what do I want to see first is, I will always try and enter into a pullback. So for example, this was the range that I drew. It came here, and this was the pullback where I would have entered. Would I have entered here? No, because again, this buying is not enough for me. What I want to see is a good absorption of sorts. Either it continues, if the market is really fierce on one direction, yes, I would have loved to see, for example, a big red dot here, and whenever the market approaches here, I take that red dot as the resistance zone, and I take the counter trade. But why didn't I want to do it here is because if you look at what has been happening in the past few minutes or hours, is that it is chopping around. So I would rather, so like I said in the last video, I would rather trade absorption than aggression. Okay, so what do I mean by that? Like we just discussed, if I want to trade in the direction of this particular trade or trend, that small trend that we have, I would have liked to see something like this blues getting absorbed, and a little bit higher number, maybe above 30 or so, and then trade the other side of the trade, something like this 36. Okay, but in this particular case, like we were just discussing, this is a case of aggression. What do I mean by that? If you look at it, there's buying which is stepped in from this point, and you see this liquidity come into place at this point if you look carefully, and the market goes up, and this is the zone where a lot of buying happened, and the market pulls back to this zone and then goes. So this is a trade that you, if you would have taken, is called an aggression trade. That is, you are basing your trade on the fact that some buyer stepped in here, and he is going to take the market further up whenever the market pulls back into your direction. The other thing, when it comes, like we've just discussed, the aggression trades would, they wouldn't be so successful in today's scenario, is because the market is chopping around. And mind you, it doesn't mean that if the market is chopping around, or in a trend, even on a trend day, you can have times in between where the market does this and then resumes the move to one side. So you have to be very, very careful what the market is doing. So at the moment, like we can see clearly that the market is not trending in one direction. By trending, what we should have had is, like, for example, if this was an aggression trade, if you would have considered, and the market pulled back here at a number like 36, and you saw good buying step in here, it should have broken this liquidity that just came here, again taken a support and gone. It's not done that. On the other hand, what we're saying is, whenever the market approaches to any point, for example, this is a fractal point, or this is the last time the market touched, if you look over here, the liquidity got came in over here, if you see from this point onwards, and the market approaches, what we're seeing is, approaches these zones and is being pushed off from the liquidity. What do I mean by that? When it comes here, it absorbs, goes just below, pops back up again, and goes to the other direction. So it's since the time we started in the last 10-15 minutes, it has done that, 3-4 times already, gone from one direction to the other, and done, it's been following the same pattern. Okay, and if you look at this part again, now if you would have entered a trade here like we just discussed, this is what is called an aggression trade. You saw buying, it took a support from this point and has gone up. Again, I wouldn't prefer to take a trade like this, because most probably it is not going to give me fruitful rewards in a market that is taking place today. Okay, so what it will generally do is, even if it has to go up, it will take these guys out, go down till this level, maybe 360, like what it is doing now, and then go up again. So I wouldn't want to trade against the odds. What I would like to trade is fade. So again, if I see something like this, a big number, I would rather want to trade an absorption. So for example, let's see, you see this volume pickup over here. This is the one place and this is one place, and you see this volume pickup and the market unable to go down in spite of, again, these numbers are not good, but since this is a point, and you see this liquidity getting added here, so I want to see a big number pop up, something above 35, 30, something like this. Okay, 31, before I decide to enter a trade. And suddenly someone has started adding liquidity here. So let's see. And what you want to ideally see is something good pullback, and then maybe take. So let's see if we can find the perfect zone to enter. Okay, so if the market does pop down below, we will try and enter a trade, and let's see. So again, this is not what I want to trade. I don't want to trade aggression, I want to trade absorption. So I would want the market to come to this place at least again, and if it is holding, see so much of buying in the market. Okay, so somewhere here is where I would like to enter, that is 51 or so, if I get that price, and then I would target this zone. Okay, that is 58 or 59. So we did get our point, 51, and let's see what happens. And the stop loss again is 6 to 7 points. In markets like these, I understand that the volatility is really high, so what you can do is have 7 or 8 points, but again, you will have to put your targets as much over there. So if you are in the trade and you see this buying not being able to take the market up, is when you start trailing your position. You see this buying, that is why we're using footprint. So I would rather have it just below my cost, because if this buying isn't able to take it up, look at this particular place. The market, okay, it does touch our target, but again, I would have certainly trailed my stop loss back to break even or somewhere just below that, and it just pops there and comes back down. So I would really get aggressive, although it does give a target, but this is you need to understand, this is how you should be when you're scalping. You need to make quick decisions. For that, you need to have a framework that works in in conditions that are different to each other, and they help you in understanding the present context. So when I said when we were somewhere here, I said I would have moved my stop here, is because I was seeing at that point so much buying coming in, and the buying numbers, if you look closely, were higher than any of the sell numbers, but the market wasn't going up. It eventually did when it took out another this zone I will draw. So when you are I mean, in your positions, or before you take a position rather, you should have these zones marked. So this is the zone where I was seeing absorption take place, and that is why I decided to enter at the bottom of the zone at like at 51, because I know if it breaks, I'm going to touch let's say 45, 46, where my stop loss would have been. So if you see, liquidity was added again over here, and again it's broken it, and if it pops back again into this range, it's going to go to into the other direction. So it has been doing this. I mean, let me just clear this, and so it has been doing this something like this. So you see this number minus 92. Okay, now what if this time it is succeeded? That is why we immediately not enter a trade like we did here. We wait and see the market's response and then react. So it took out this liquidity, it took out another set of liquidity at minus 45, and you see this, if this selling is so strong, the market shouldn't come back up again. So if you for example decide to trade a short or take a short here, you would be trading aggression like we just discussed, because there was a big sell order here. You decided that this guy is going to step in and again take the market down in a further move to the downside. But as of now, what we have seen till now, the market has not changed into that regime. So most probably if it enters into this zone, let me draw this particular zone so that it becomes easier for you to trade things, stuff like this. So if it enters back above this zone, what we're going to see is a test of the other side. At least that is what we've been seeing. Now another small zone that I'm going to draw is where I've been seeing a lot of selling, is this small zone within this zone. So if you see within Bookmap, it becomes so easy that I see these huge numbers not being able to take the market down. So when the market does touch this, is where we initiate a sort of like somewhere here a long, contrary to what has been happening, because I am not expecting these sellers to take the market up, and it does give our 6 to 8 or 10 points, whatever it is, when we enter it. Let's see, 41, and it popped up to 47 or 48. So 6, 7, 8 points, whatever you, and now it has gone down. So you can, let me clear the drawing. And it's okay to, I mean, even be correct 6 to 7 times, because generally we keep a 5-point stop loss against an 8-point or 7-point target. And even if it, your I mean win rate is 60%, it would generally help you get good results. Okay, now if you see closely, you see this liquidity getting added when this particular zone broke. Okay, and why would these guys would have, I mean why would they have stepped in? Maybe they thought that the market is going to go down, and look what it does. It again pops down below this particular level and goes back up again. So this is again what we've been discussing. When you see something like this, I mean, the probability of this working out is so good. It's, I mean, I think very close to 70%. So I just blindly, when I see something like this, okay, a sell zone here, another sell zone here, pop up, fail. As soon as it breaks here, I enter somewhere here for another test of this liquidity zone where it's come and it is broken down. Now something interesting that we're seeing here is, this is something what we've not seen since a past few minutes, is look at this liquidity zone. Firstly, it has not been taken out and it has not moved out. Okay, so this is what you need to consider. In all the other instances, whenever the market approached, the liquidity was taken out, it was not visible. This time when the market did approach, it was not taken out and it's still there for it, I mean for your consumption. So that is interesting something. Now let's see what it does this time when it approaches this place. Let's take out, so the zone I'm talking about is this one, that is 345. Okay, so when you see something like this the second time, you can trade aggression. Again, you would be thinking, why am I changing, or why am I'm changing my position? Because I am being dynamic. I cannot be I mean fixed with my thought process. That is why I said it's so important to have a framework in your mind whenever you're trading markets, and whenever the situation changes, you have to change, you have to adapt. You see, this time it's not been able to, even though it has popped, it has not been able to touch the liquidity zone. That is an interesting fact. The other thing that has happened even recently is, now I see two zones, okay, one here and one there. So wherever it breaks, it will most likely give us a good move. And it can, what it can also do is pop down, go above, pop up, go down, and it can keep doing that. So what you the best thing that you can do is keep waiting over here, because at this point you have no idea what the market is going to do, because I've seen liquidity on both sides, and I will also be ready if it breaks and pops back again, something like what it's done here, to go on the long. And similarly, if it does something similar on the upper side, I'll be ready to go short. So at the moment, when this was not there, I was more inclined towards the short side, because I saw this liquidity stay in and instead getting added. 42 added over here, 26 added over here, 79 pulled out of here. So if you're wondering what this is a liquidity marker. Again, you can go here. I think you will get this with any of your subscriptions. This is the one that I have. You go here and you can see the settings that I've set, and I use this so that I can get an idea of where the liquidity is being added and reduced, so that I get an idea on how the market is playing. For example, somewhere here, minus 58 was pulled out from here when the market approached here. Similarly, now if you see, of course, the numbers here are higher, these two places. Now something has got, you see plus 60 liquidity being added at this point, even though the market is going down. So these guys have been wiped out. Let's see what happens. And most probably this is also going to get wiped out again whenever this was added. And now if it pops back again above this range, that is 329, 330, this still remains something. See, this is what I was talking about, a pullback to this place, and you can enter long, because hopefully it should enter this range and go to the other end. So this is what we like to play. And although it has not entered this range, what we want is to enter this range. It has been failing. Let's see what happens. A stop loss again is this liquidity level 322, and what we expect is first a touch of 331, and then maybe a touch of 331. It did achieve, and then maybe a touch of 337. So when you get your first targets, again in scalping, you should have your bracket orders in place. Something whenever 32 or 31, your 7-8 points are met, you take your first stop, first target. And if you see something like this, like we just discussed, in a choppy market, the buying not being able to take up the market up, you take whatever you're getting, because if this is not able to take your market up, or you trail your stop loss back to your break even, because this is a sign the market is going to go down. It has to not stay here, it has to go up. And there's nothing wrong in trailing your stop loss here, because you've got your first target over here at 37, 38, almost from 10, 11 points that we wanted. And this is how you can play these moves and be aggressive in your stops. You see this liquidity getting added here at 30 when the market moved up. So hopefully this particular move should take it to, let's see this place, 38, and it is failing. Let's see what happens. But this is what we expect. This liquidity zone 39, 38 is what we expect to get touched, and then the market may or may not continue and move down further. So hopefully it does break this and go down. Okay, so that's interesting. So in spite of these guys coming and looking super confident, it failed. So that is what I mean. So you have to be very careful and trust the process. You can be wrong 2-3 times, right 5-6 times. In the overall run and the big picture, if you have your framework in place, you will always end up on the winning side and remain on a steady ship. So hopefully I was able to